Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investor's Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome to the Smart Property Investment Show.
Okay, how you going? Welcome to the podcast. Thanks for joining us today. Phil Tarrant here. What do I? I've got a couple of jobs, but for the Smart Property Investment Show, I am the executive editor of Consumer Wealth and Real Estate here at Momentum Media. Momentum Media, for those of you who don't know, works across a whole bunch of different areas in Australia, from property and real estate, obviously, and finance, all the way through to accounting and law, defence, aerospace, space. You know, it's a very broad remit. I get a lot of pleasure working across the consumer wealth and property side of things, which includes Smart Property Investment Show. A big key focus for me, and I get to navigate this great sector and speaking to people from across the ecosystem, whether they're experts within the domains of property and consumer wealth, all the way through to those who are leveraging property and other asset classes through our connected brand Nest Egg to prepare for a much better retirement. Often it's a challenge to work out getting a good spread for the different guests that we have on this show, but I think we do a pretty good job. They interchange or intersect between property experts and people who are experts within the business of property and real estate, as well as those property investors who come in and share those stories. Today is going to be a bit of the former. I brought someone in the studio, one of the most informed people I know in Australia around tax, and whether that's a good thing or a bad thing, I don't know. I don't know how popular this guy would be at barbecues, but no doubt everyone's always got a question about how to minimize their tax or how they can be more effective about their tax. In the studio with me, Tony Greco. He's General Manager, Technical Policy at the Institute of Public Accounting. He's back on the show. I connect with him at least yearly, just to get a bit of inside view. He's got a good view on what's happening in tax in Australia now and into the future. We're going to get into all things tax, considering that and the financial year now is just around the corner. Tony, how you going?
Yeah, hi Phil, and warm welcome to all your listeners.
Is your passion for tax waning, or are you just getting more into it day by day, Tony?
It's always challenging. COVID obviously has put a lot of pressure on the profession. I think they've responded very positively, and I think that trusted advisor relationship has been strengthened, if anything. But it's been a hard slog, Phil.
Yeah, it has been, and I've sort of said it beforehand, and it's a theme that you sort of hear around the sort of accounting circles now, that the accountants or those people that work within the business of supporting small businesses, tax accountants and advisors, with the doctors and nurses for the SME sector during COVID-19. And, you know, you and your association, the Institute of Public Accountants, right on the front line, because you mainly service those tax practitioners and tax experts and accounting experts that operate that SME sector.
Yeah, that's right. That's our bread and butter, and that's what we focus on. It's the lens that we look at everything through, and hopefully our members appreciate the focus on the small end rather than the larger end.
Yeah, and a lot of those members within your membership base, and if you think you're sort of high street type family tax practices, smaller offices right across the nation, and you also have exposure up into the Asia Pacific, the UK as well. But largely these people who are servicing these type of tax clients are also servicing a lot of property investors. Most SME business owners that I know will have some sort of, or be dabbling in property in some way or another. So no doubt accountants that are supporting business owners as SMEs are probably also helping with their wealth creation strategy, Tony.
Yeah, Australians in general have a love affair with property, and I think it's interesting dynamics playing out in the market. We've got unheard of record low interest rates, and you don't need much capital growth. So property as a sector is quite attractive at the moment, and I imagine that's causing prices to go north. But it isn't across the board. We're seeing softness in the apartment market, but then we're seeing, like I'm Melbourne-based, our residential property, detached housing has just gone north, especially in the seaside suburbs where people are 1 or 2 hours away from Melbourne. They've just taken off. And it seems like a love affair for detached housing. And the government, to some extent, has contributed to the property price going north. I mean, the home builder was exceptionally successful. It's finished off, but a lot of first home buyers have jumped into the market, and they've been not active for some time. So we've got that to play out. And I'm told there's 2 years worth of work now just in relation to the home builder grant. That's going to create a few bottlenecks. But, you know, property is seen as a safe investment. I mean, history tells us that a lot of people can make money out of property. And I think when interest rates are so low, I think its attractiveness just goes up quite a bit. And I think that's what's playing out in the marketplace to some extent. But then we've also got some negatives, immigration, the lack of, but we've got expats coming back into the marketplace. Students who would normally occupy quite a lot of rental accommodation aren't there en masse. And so it's not all one-way traffic. It's interesting to read all the pluses and minuses, but it's definitely heading north for detached housing in Melbourne, Phil.
Yeah, and we're seeing that in Sydney and right across the country. And very much what you're seeing is a bit of a two-speed market appearing, where you've got in some ways where a lot of property investors do operate or have operated traditionally, the inner city sort of new build apartment market. You've got pretty significant vacancies in that area right now. You've got a lot less, to your point, international students there. It's a flight to the suburbs for some people. They're realizing that they don't need to live in a city as a result of more flexible working arrangements. So, you got to see up and downs. And there's already some commentators coming out saying, hey, watch that inner city apartment market, because in 2 and 3 and 4 years' time, when migration restarts or kickstarts again post-COVID, once we've got vaccine rollout, once international students start coming in, there is an undersupply building before COVID and during COVID. So you're going to get a bit of a compression at a point in time. So I don't want to go too much into that today, Tony. It's probably outside of the remit of this, but I want a bit of a lesson from you, Tony, because I get questions quite a lot from our listeners, and we can be super technical on this podcast. We can be quite sort of 101 for those people that haven't done it at university. Is your first course in something at uni, as in base level. So it's a broad church, Tony, but I sometimes get questions where people, and probably you're a good guy to answer this, that don't really understand, and this is at a sort of macroeconomic level. So there's two ways in which an economy works. There's the settings that happen in order to shape the way in which the rules that govern the economy, and then it's how it plays out individually with people and businesses and industry sectors and stuff. So the relationship between Treasury, because a lot of people don't actually understand what Treasury does, and I know that you have quite a lot of involvement down in Canberra because of the work that you do. So the relationship of Treasury, the relationship of the Reserve Bank of Australia, how that dictates what happens within banks, which therefore determine what interest rates are that consumers get. Can you give us a bit of a lesson on how all that works together, mate?
Yeah, I mean, the framework, the government sets the framework. The RBA has its part in that framework. So it starts from the top. Like, essentially what the government is about at the moment is recovery. So we've gone from intensive care, where essentially the government had to jump in and put a lot of income support into the economy. And it's gotten us through that COVID ugliness, let's say. And now they're still very much on recovery. So given that, we don't expect a lot of, let's say, belt tightening in the coming budget. So things like changes to the attractiveness of people investing in property, we don't expect any changes. So because the government's not focused on fiscal repair, because we're still in that recovery. So they very much give us the broad parameters, and the RBA is doing its best with interest rates to make sure that the economy does recover. And its hands are pretty tied now in relation to, we can't go below 0.1 cash rates. It's almost hit rock bottom. We haven't got to the stage where we've gone into negative interest rates, and there was talk of that maybe last year, but we haven't gone there, and things are looking like interest rates will go up sooner rather than later. But the Reserve Bank is pretty much telling the market that we don't want to increase rates within a 3-year time horizon. Now, that sounds quite attractive. Whether that will play out that way, I have my reservations, because the economy does seem to be rebounding quicker, and eventually inflationary pressure might force the government to, allow the market to increase the rates. And I think that's a natural progression. So we have to factor in at some point in the cycle, and property is very sensitive to interest rates going up because it's all been going down. But at some point, the cost of borrowing will naturally go up. And so those settings are very important. And I know a lot of people are looking at New Zealand market that's red hot, and I think that it's risen much faster than the Australian market, and their government and their equivalent Reserve Bank has had to put in some measures to cool it down, and they're quite draconian, and one would think that will not play out in the Australian market. But, pre-COVID, many, many years ago, 3 times the average was roughly what someone was required to buy a property, their first property. Now, pre-COVID, that number went to about 8 times. Now, that number is still quite high. By international comparisons, we are, property prices have moved quite substantially. And we're in a situation where there's bugger all or very little income growth. So that's going to be a natural ceiling. I mean, you can't just keep increasing the average period of you'd hate to think that 8 times average earnings starts to go up to 9 or 10. So I think there's a natural ceiling where in the absence of income growth, that will play its part in future price growth. But then I'm not an economist, so I can't make these bold predictions. But at the same time, you'd sort of think at some point it will start to stabilise, Phil.
Yeah, it would do. And what you're sort of talking to there, Tony, I think it's IMF metric with income versus price of property, and Australia ranks super high. And if you speak to any sort of global economist, they'll always flag, well, you've got a property bubble in Australia because of that particular reason. But often they don't take into consideration the uniqueness of the Australian property market.
Correct.
Hong Kong, parts of New York, London, they all operate well above 8. And I think it's just indicative of Australia being a bit of a lifestyle superpower here and the inherent value of property here. And I can't see that waning too much. But, to the point around calibrating price growth in Australia, and if you go back 30 years to say that in Sydney, the average or median price is over $1 million, people would say there is no way in the world that will ever happen. Well, guess what? That's where we are right now. So what you can guarantee is that property will continue to grow in value. But this comes to the scaffolds or the architecture of government to make sure that we don't grow too fast. So Treasury's got a role. You've got the Reserve Bank of Australia has a role, but you've also got, that's structurally, but then the apparatuses of that would be something like APRA, the prudential regulator. So that's the person that really tells, the banks what they can and can't do, as in make your money more expensive or stop lending to these type of people. And we've seen that over the last couple of years. So there is buttons and levers that can be pulled on behalf of the government to make sure there is stability. Yeah,
absolutely. Those controls are there. And I think they switched some of that off during COVID. And now we're looking back to post-COVID. But loan to valuation ratios, those sort of things can be quite powerful, or the servicing of the debt, making sure that if there were to be interest rate increases of some denomination during the loan period, that's factored into the servicing and therefore the amount that someone can borrow. They are very important, and they could also play their part in cooling the marketplace, because if you eliminate buyers from the marketplace, that just means less people chasing that fixed number of properties, and that will have some levelling of or sort of stabilising the marketplace somewhat. So I absolutely agree with you, Phil. And property will continue to rise, but then the government can also play a hand on how much it can rise over an extended period by imposing certain or contributing towards some small shifts in some of those controls that they have, that are, I call them tools that they have at their disposal.
Well, what's the sort of baseline philosophy, do you think, from the government? At the moment, we've got a Liberal national government under Prime Minister Scott Morrison. Their philosophy is for the betterment of Australia and helping Australians create wealth, right? I imagine that's a central philosophy to how they want to go about making their decisions. So they're not deliberately trying to make it harder to own property in Australia, but they've got to be considered about making property accessible to as many as they can. It's a tough equation, isn't it?
Yeah, you've got different. I mean, obviously, you want to reward people. The biggest 2 assets most people will own is their home and their superannuation. And you want to protect that, because that impacts on confidence. And confidence is very important in an economy like Australia. As soon as people are fearful, then they tighten up their belts. Now, but you also want to make it a reasonable expectation that someone can buy into the market as well. So you've got those 2 opposing forces that it is tricky, and it's not an easy position to be in, to make sure that one doesn't get out of kilter with the other one.
Yeah, tough one. But there's people that do this day in, day out, Tony, and very big, bright minds who understand the economic engine that is this nation. But, back to property investment, myself included, and I know you invest in property, Tony. as a way to create wealth and give us choice into the future. That's why we're doing. Now, you spoke really quickly about the budget. I want to get into some, preparations for tax time, which is just around the corner. But you mentioned you don't think the government is going to tinker too much with what they're doing right now come May when the budget is handed down. Now, it was thrown into a bit of disarray last year with COVID. I think the budget was held in October, by memory, Tony. So it's back to May. I join you in Canberra every year. It's one of the highlights of my year where we are on budget night and we sort of talk through all the different nuances of what it all means, often towards the end of it over a glass of wine, which is a nice way to stress test what's happening. What do you reckon we're going to be talking about this year when we get together on budget night?
Yeah, I mean, as I said earlier, I think the budget is not going to be concerned about repair. And I think I'm not expecting many property-related tax changes. I mean, obviously, if we have an election this year, we haven't been told by the Labor government whether they're going to still proceed with the changes they took to the last election, and that's on the horizon. But the government, our government, or the government in power as we speak, hasn't sort of adopted those changes. But that's something on the horizon we have to be mindful of, Phil. If there is a change of government and they take that to the next election, we're talking about limiting the benefits of negative gearing and also the capital gains tax discount. So they're two big things which we haven't got line of sight from the opposition. And then depending on what they do, who knows whether that'll influence the Liberal National government as to whether it needs to move in that same direction. But there's a lot of politicians with property investments, Phil, so I'm comforted by that.
Yeah, most of them do have a stake somewhere. So even the Labor government, I think Albo even owns a couple of investment properties. So maybe we can get him on, he can have a chat around it and get some indication of whether they're going to mess with that.
Yeah, I think there's one politician on record has 42 properties. So, yeah, more than you and I, Phil.
Well, let's get in a bit more. We'll go to a break before I'm back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm joined by Tony Greco, a good friend of the Smart Property Investment Show, Momentum Media. He's from the Institute of Public Accounting. He's the general manager of technical policy, lives and breathes tax, I guess. If I was going to meet you at a barbecue, Tony, I didn't know you, would you say you're a tax guy or?
Well, I've got a tax focus, but I think I'm a bit more broad-based. I think I can talk on lots of things, but in the mix, absolutely, Phil.
Yeah, and sort of technical policy. So your work within the IPA is to give the mechanism of government and those who are involved in making determinations of the rules, insights to influence or shape their decision-making. Is that a good description of what you do?
Yeah, I mean, the government it sets the policy agenda, and there's always things on the drawing board, and we try to make sure that they understand the ramifications of anything they're contemplating. And it's not just property tax, it's everything. It's tinkering with our personal tax rates, it's dealing with deductions, it's dealing with capital gains. It's the Tax Act itself is over 10,000 pages. You'd never get to the bottom of everything, but there's always tinkering happening, Phil, and there's always policy changes. Like we saw non-residents, for example, if they sell a property, they don't get the main residence exemption. How cruel is that? I mean, things do change. I mean, that's effective from 2017. So that's a horrendous change. So if you happen to be a non-resident, even though you may have lived in something for most part of the period that you own that property, if you happen to sell in your last year when you're not a resident of Australia, you don't get the main residence exemption, you don't get the 50% CGT discount. How severe and draconian is that, Phil?
Well, it depends. If you're in government, it's probably not a bad way to get a few shekels in the old bank account. But this goes to the point as property investors or even people who invest in properties, owner-occupiers, you need a really capable accountant to help you steer and navigate it. And sometimes it's too late when you actually start down the process of selling or realising the value in a property asset. You know, my view is that the accountant needs to be right at the front end of any property investor's journey. Myself, I've got a great accountant. I get him on the show quite regularly, and he's a property investor himself. He knows it inside out. He can do the compliance work, but that's just an expectation. It's about the strategic guidance to help shape structure but also the ramifications of that when you look at someone's holistic tax position come tax time. And that's what we're getting towards right now. If you don't have a good accountant now as a property investor, Tony, I reckon you'd probably recommend hurry up and get one.
Yeah, you've always got to be cognizant of all the rules that are there already. And a lot of people haven't even caught up with some recent changes, like the vacant land changes. Most people aren't even aware they were tinkered with back in July 19. And to give you a COVID example, someone may have a residential property and, they haven't been able to find a tenant. And so they've decided to, let's do some capital improvements because the market is quite awash with listings, and this might be a good time to, pour some money in it, make it in the expectation of trying to get a better rental. They might take this period now, if they don't make that property available for rental, they can't claim any of the deductions. So there's something that happened in 19. Now, having an accountant just making sure that investor is aware of that change that happened 2 years ago, 3 years ago. That's just one small example, Phil, of that, having that relationship and making sure that those rules are understood. So that's just one of many examples of where, or as I referred to earlier, if you've lived in a property for 20 years, but you've relocated in your last year and you don't want to sell that property while you're overseas. I mean, just knowing that requires some relationship with someone who's in the know.
Yeah, absolutely. And for those property investors listening to this who are about to embark on their journey, or they're not necessarily satisfied with what they have right now, what sort of questions, if you're shopping for a new accountant, should you be asking to make sure that because not all accountants are created equal. Some of them are very capable in certain areas. Not all accountants are property specialists. So what would be the sort of 2 or 3 questions you'd be asking to assess whether or not a particular accountant is right for you?
Yeah, I think it's basically what most people would probably undertake anyway, to see whether the accountant has the expertise in helping the particular person. Like, do you have property investors in your portfolio? Are you aware? I mean, the personal circumstances of every individual are different. Like, your mix of investments might be completely different to another individual. So it's just matching, and someone you understand that doesn't talk technical rubbish that you can't understand. So it's very important that you communicate in a way that's understood. So you've got to have that rapport with the person. That person has to have the exposure to whatever you're exposed to as part of your individual circumstances, I think, and just making sure that they communicate in the language that you understand, and they're not just there to do compliance, because, that's not going to help you in a lot of ways, because that's almost a given. You want someone to explain the ramifications, not just today, but tomorrow, and to keep you in that loop of making sure that you understand what potentially is coming. Like, if there is a change of government, what's it going to look like for your circumstances? You want that sort of real-time loop, information loop. Or this change is coming, what do you need to do? What do you need to be aware of? I think it's a tailored approach that matches whatever you want from that expert, Phil.
Yeah, absolutely. And, and I think your accountant is only as good as the relationship you create with them, Tony. And I know with my accountant, I've sort of given him carte blanche to give me a hard time, because he knows sort of helping me set strategically where I want to go and how I want to be utilising property as a tool for wealth creation. When I start waning or start to lose my way or losing interest or whatever, like, he'll give me a kick up the backside and keep me on path. And I think that is a critical role of an accountant. That's just not the compliance. That's where they can make a huge difference for property investors.
Yeah. I mean, compliance is almost a given. I think most people or most experts out there can do that day in, day out, but it's that other bit that I think adds value to the relationship. And I think that is the bit that's a little bit underestimated. You just don't want someone to do your compliance work and not tell you that this hand grenade's coming your way. It's nonsensical. It will have a big impact on the way you go about your business of creating wealth. So if that information loop is not happening, it's going to cost you dearly, not being aware of those grenades coming your way.
Yeah. And no doubt, Institute of Public Accountants all good across all these facets, Tony.
Yeah, I mean, we do our best to keep our members alert to all and sundry. And there's never a period where there's nothing happening. And it's a case of trying to make sure that they're well aware of things that affect their clients. Because in the end, we're looking after their clients by keeping them informed. And whatever's on the horizon that, is a negative for their client base. We try to make sure that that's communicated well enough so they pick up on those overturns and do their bit in making sure that clients see what's coming and maximise. I mean, it works both ways, opportunities, but there's also negative things that on the horizon. So it's a bit of both, making sure that you maximise any opportunities. Like the government, has put in a lot of attractive measures to make it easy for people to invest, not so much for property investors because they're not considered a business. But if you are in the business of, property construction, you're on revenue account, then the floodgates are open. You can pretty much write off most capital acquisitions. But if you're a property investor and it's called passive income, you don't have those same opportunities. But then, if you want to consider yourself or move into that area of property development, then at the moment, the tax settings are very favourable, Phil. So, knowing all that and having that conversation and your accountant being aware of, what you've got in your mind and that you're contemplating, that is very conducive to either adding to those fires or maybe thinking about the negative side of whatever you're contemplating.
Yeah, absolutely. And let's get a bit technical now, Tony, and sort of a bit off track there, but I think it's important in relation to making sure you've got the right team on your side as a property investor, and your accountant is absolutely critical. So if you've got any further questions about that, we talk a lot about it on smartpropertyinvestment.com.au. Go and check it out there. But let's get into some sort of technical tax stuff just to round out the podcast. We'll just go to break beforehand. Back in a moment.
Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with the General Manager, Technical Policy, Institute of Public Accountants, Tony Greco. Now, Tony, COVID's thrown a spanner in the works to some of the tax ruling and the way in which property investors have been able to generate income, moratorium on kicking out tenants if they're not paying their bills, all this sort of stuff. So no doubt a lot of people's accounts for the 2021 financial year is probably a little bit messier than years prior. So make sure you speak to your accountant. But with tax time nearing, any particular COVID changes do you think property investors need to be right across, mate?
Yeah, COVID has put different lens on everything. There's COVID impacts pretty much across the board, and residential property probably no different. Maybe the tenant hasn't been able to make the payments. One would have thought with JobKeeper support, they could make some payments. So rental income might be, or, if you're short-term accommodation, a lot of that, it's stop-start. So you may not have, so you're looking at the quantum of losses, if you're negatively geared, might be larger. So, making sure you get value from that will very much depend on an individual circumstances, as in, have you got the ability to offset that against other income? But generally, interest is still deductible. So long as you made the property available for rent, and if they're in there and they can't pay, that equation still stacks up. So there's no changes to deductibility that I'm aware of in relation to not being able to claim that. But on the income side, you might be seeing no income or little income. So the tax system will generate greater losses, and hopefully they are able to be offset against other income. That's one of the benefits of property investors enjoy. So there's no tinkering with that, Phil, but it is a realistic. I know a lot of people who have had to reduce the amount of rent that they charge purely because of market conditions, and therefore they're hoping that those losses can be offset against their other income. But yes, if you don't have that other income, then you're carrying that forward, so you don't get the immediate benefits. But it will play out, Phil. There generally will be, but like I said too, if their tenants have left and the property is still available for rental, then they still claim an interest deduction. But if they've stopped making it available for rent for whatever reason, they undertake major repairs, just be aware that they may not get that deductibility of all the holding costs. And i.e., we're talking rates, we're talking interest. So just be aware that there is a huge ramification if the property is what the rules refer to as not available for rent. And I'm not talking about like at the end of a tenancy, there might be a couple of weeks between finding a new tenant, that's okay. That we're not changing the rules there. But if they decide to pull the property from the market to undergo some repairs of a lengthy nature, then that upsets the apple cart, and they may not even be aware of it, Phil.
Yeah, absolutely. And what you're pointing to there, and we've had some senior people from the tax office on this particular podcast, Smart Property Investment Show, Tony, and I was sort of quite encouraged by their philosophy. Is what I've embraced as a property investor is it's about disclosure to the tax office. It's when they go and audit you and they find discrepancies, and to that case in point, if you're making deductions or claiming deductions at a point in time when your property wasn't available for rent, well, that's not in line with the tax code. So it's incumbent and it's the responsibility of the property investor to make sure that is absolutely disclosed, because when it's disclosed, you're absolutely fine. And your accountant can only prepare your accounts based on the information that you give them. So you need to, with your accountant, make sure you're giving absolute transparent reality of how you're managing your property investment. And if you do that and you follow that particular philosophy to working with your accountant and making sure that you prepare your accounts to that in that order, you should never really have a problem with the tax man, right?
Yeah, that's right. The rules are there. Some of it's black and white, some of it's a bit on the fringe, but just like if the property owner or investor knew that that was the consequence, then it's an informed decision. They can then think about whether they do it or don't do it, but not being aware, not having that relayed back to their accountant and understanding the implications of that decision. You don't want to be in a situation in 6 months' time that that information was available to the accountant. Then an audit could uncover that, and that would be an ugly situation, Phil. An example of where just not understanding the rules catches that investor out. And that's not an ideal situation, because then penalties and interests make it uglier than what it should have been.
Yeah, absolutely. And that happens. And I guess another sort of technical point during this COVID period, Tony, a lot of people actually took interest holidays where they deferred their loan payments. So they just extended their loan by 6 months. So for a period of 6 months, they didn't have to pay for the home loan. So it's another potential place where people could get tripped up if they try and claim those loan payments during that period of time when they weren't actually making those loan payments. No doubt that's probably a pretty easy data matching exercise for the tax office, right, with banks?
Yeah, I mean, you can deduct expenses that what the Tax Act refers to is incurred. So you have to have incurred the expense. That's fundamental. It doesn't mean you physically have to have made the payment, but there's an obligation to make that outgoing, and therefore it's incurred. So there is a little bit of wiggle room there, Phil, in the sense that that interest may still be deductible under certain conditions, but it's just knowing the ins and outs of that arrangement that's important. I mean, if you borrowed to buy a residential property and it's available for rent, generally that's an outgoing and you can't not pay that interest at some point. And if it has been incurred by the definition of the Tax Act, then it's still able to be claimed as a deduction, but generally the tax office wants to see a payment, and that's probably what you're referring to. In some cases, it may not be enough to claim if you've pushed it down the road.
Yeah, and this is, I guess, in business, it's when you accrue stuff and also when you pay for stuff can be two different things. With property investment, for most investors, as a passive investor, rather than running a business property, it's very much sort of cash accounting, right? It's when you actually pay the bills, when you recognise it. So if you're not technically and paying for the interest repayment at that point in time, you probably don't, for most investors, I doubt you'd be showing that as a deduction during that period of time. So, and that's going to shape people's financial accounts, right? Because if there's been a whole bunch of expenses that you haven't paid for during that period of time of COVID-19, it could turn a negatively geared property portfolio into a positively geared portfolio. And there's going to be tax consequence on that, right?
Yeah, absolutely. And it works in reverse too. I mean, you can prepay 12 months worth of interest to actually do the opposite. And that is, if you've got enough income and you haven't been adversely impacted by COVID, you could absolutely do the opposite too and prepay some extra interest. It works both ways, Phil.
Yeah, and that's when you get quite tactical with how a good accountant can work with you to start thinking about these opportunities. If, you've got a one good year and you're thinking next year your income generating capacity might be changing, you might go from one income to two, but you've got the ability to prepare that interest into time, means you can minimise your tax this year with view to stabilise cash flow the year prior. So, work with your accountant and all this sort of stuff. You touched on it really quickly, Tony. I'll sort of close with this negative gearing. The current government's not going to tinker with negative gearing. I can't see it. And whether or not when we do go to election. When's your read on the election? Any idea when it's going to take place? Next federal election?
That's a political decision that there is some flexibility. Obviously, if this rollout wasn't if it all happened to plan, there was a strong likelihood that it could have been this year, Phil.
Yeah.
But I think a lot of things have gone off the rails, and maybe that might not tempt the government to go early. So I think it's a difficult one to read, to Phil. I don't want to play that game because it's got too many political ramifications. But I think certainly it's looking more likely next year rather than this year. I think the vaccine rollout is pretty much going to occupy the government efforts in bedding that down, and the recovery, making sure, JobKeeper has officially ended. No one knows how much it will add to the unemployed, those people that there's a bit of guesswork happening at the moment. We'll probably get a good feel for that. And just reading the AFR this morning, they did some research about property intentions of those on JobKeeper, and I think there was some statistics saying that some people are thinking of selling because that income support is not ongoing and they're in displaced sectors. But I don't think that's going to have a massive influence on the property market, but it's one of those things that will play out. So again, the recovery is pretty much going well, but then we don't know how backwards we're going to go in the month of April when all those people off JobKeeper, and numbers have been speculated, but no one really knows, Phil. So my guess is we're looking at the following year, but also looking for confirmation of ALP policy, which one of those policies, because they took a lot of negative tax policies to the last election, and the only one that's been taken off the table is imputation credits, but negative gearing was in the mix.
Yeah. I look, if I was advising the Labor Party, I'd probably say for this election, I wouldn't go down on the platform of tinkering with people's wealth right now. And when you consider the spread of property investors across the whole ecosystem of Australia, when you start messing with people's rice bowls, that's going to really shape their view towards who they want to have in power. So I'd be surprised if it was a central policy for the Labor government to come out to contest this election, trying to take away money from people, particularly in an economic climate environment which is looking towards recovery rather than going backwards. And I don't want to get on the negative gearing bandwagon, but we need to remember that a lot of the Labor homeland and people that do vote Labor are often property investors. So let's see how that plays out, mate. But it's outside of our pay grade, I think, Tony, to get too much into that.
Yeah, no, absolutely. That's one reason why I don't think they would contemplate changes, but also more recently, New Zealand has put some of those things on the table, like, the deductibility of interest for an investor, some really draconian rules in place but again, their market has gone up a lot more than ours, and they were sort of forced to slow those rises, which were out of kilter. We haven't quite got there. And like you said, two-speed marketplace happening at the moment, so it's not broad-based. So I don't expect that those sort of draconian measures will be adopted. But, the political sensitivities, you're absolutely right, Phil. I think Labor heartland is very much in property just as much. So they have to be very mindful of what they're doing and their chances of getting in power.
Yeah, and it's always a challenge and, the consideration of the government. When you think of, Tony, some of the APRA requirements as of sort of 3-4 years ago with a cap on investment lending or the speed of growth of investment lending to slow it down to the banks, that was a universal federal policy Australia-wide where it was really only aimed at targeting two particular markets, which was Sydney and Melbourne. When you think of other parts of Australia at that point in time, Perth, for example, was going backwards. So there's this sort of consideration that no matter what you do at a sort of macro prudential level impacts all of Australia, where it necessarily is not the way to go about doing it. So it'd be nice to see how all that plays out. But, when you think of, and this is the fear for a lot of investors in New Zealand, I don't know the answer to this, maybe you do, that everything is grandfathered up until now. It's only for new investments moving forward. There's no way in Australia that could say everyone's mortgage repayments aren't, the interest on mortgage payments now is not deductible. You can't just do a wholesale change of the tax system, or is that possible?
Well, we all argued against the changes for non-residents. Like if you owned a property for 20 years and then in the 21st year you relocate overseas, who would have thought that you wouldn't get at least 20 years main residence exemption? Now, we argued until blue in the face in relation to this thing is just unfair on steroids, but the government proceeded. Now, I agree with you. I think non-residents are it's a minority group that will be impacted by that change, but it was quite draconian. Who would have thought?
Well, they're leaving anyway, so it doesn't matter. We'll take our clip on the way through. Yeah.
So never say never, but it would be it would be brave for any government to tinker with something that is, like you said, pretty broad-based. So we've got over 2 million individuals who dabbled in property. That's directly, and then you've got all those indirectly. It's quite a sizable cohort, and I mean, the government has a lot of decision-making going forward, like age pensions, retirement incomes, the exempt status of the home. There's a lot of bigger things that they need to address before they get to property investors. So, I'm hopeful that, like you said, whilst we're in recovery, you don't want to upset the apple cart and send people's confidence south during this delicate transition from intensive care to recovery.
Absolutely. Well, Tony, I always enjoy catching up, mate. We covered some ground there, some sort of macro and micro stuff around tax. Keep up the good fight. You're still walking the halls of power, trying to bang on some doors and influence tax policy. I hope that's still happening.
We're fortunate in being consulted on most things, and we do our best to make sure the views of our members who service small business and obviously property investors are not unduly disadvantaged. But so we'll keep the fight up, Phil.
Nice to hear, Tony. So that's Tony Greco, General Manager, Technical Policy, Institute of Public Accounts. Again, go and check them out. What is it? ipagroup.com.au by memory is your website address. Yeah, that's great. Thanks for your time, Tony. Appreciate it, mate.
Thanks again for the opportunity, Phil.
Nice one. Plenty of tax stuff on smartpropertyinvestment.com.au. Go and check it out. Any questions at all? I'm happy to do a really technical tax podcast. We can get Tony in, we can get some accountants in, however we want to play it. Send them through editor@smartpropertyinvestment.com.au. We'll have some fun with that. I quite like talking tax because it is a big, important part of the effectiveness of the equation for property investors. A lot of people think tax is just something as an afterthought, but if you put it foremost and front and center of your property investing, you'll do a lot better as a result of it. Social media, Smart Property HQ is where you'll find us. One favor, please. The team get a real kick out of it here. Those reviews, please keep them coming on iTunes or whatever podcast platform you're listening to this on right now. It's great to see that we are making an impact to this great community of property investors, and we're all in the same thing. We're trying to all make a few bucks out of investing in property. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.